In this video, we will explore about technical indicators and professional standards. We are going to cover a comprehensive guide that bridges the gap between analyzing market charts and adhering to regulatory rules. As you can see on the screen, we have two sides to this coin. On one side, represented by the bull and bear, we have the technical aspect, which includes identifying trends and using momentum oscillators. On the other side, we have the compliance aspect, focusing on the regulatory framework, the investor charter, and risk management. This holistic approach ensures that you are not just a good trader, but a responsible and compliant one. Moving on to our first technical tool, let us look at moving averages. A moving average is simply a way to smooth out the noise of daily price fluctuations to see the clearer picture. Think of it as a curved line that follows the price. We use a specific strategy here called the Fibonacci combination strategy, which uses the 13, 21 and 34 period exponential moving averages or EMA. The rule is simple. If the price is greater than the 13 EMA, which is greater than the 21 EMA, and that is greater than the 34 EMA, you are in an uptrend. In this scenario, the 34 EMA acts as a support level where prices often bounce back up. Conversely, if the price is below these averages, you are in a downtrend, and the 34 EMA acts as a resistance ceiling. Next, we have the moving average convergence divergence, commonly known as MACD. This tool is like a speedometer for the market's momentum. It consists of two lines. The default line is the difference between the 26 period EMA and the 12 period EMA. The second line, called the signal line, is a 9 period average of that difference. When the fast line crosses above the slow line and both are rising, it is a bullish signal telling you it might be time to buy. However, you must watch out for warnings. If the price is making a higher high, but the MACD is making a lower high, that is called negative divergence. It means the upward momentum is running out of gas and a drop might be coming. Now, let us examine the relative strength index or RSI. This is an oscillator that moves between 0 and 100. It measures how fast and how significantly prices are changing. It is excellent for identifying if a stock is overbought or oversold. In a strong bull market, the RSI tends to stay high, rarely falling below 45. In a bear market, it rarely rises above 55. A key strategy here is looking for divergence. If the market makes a new low, but the RSI does not make a new low, that is a bullish divergence. It suggests the selling pressure is fading and it is an early signal to buy. Sometimes you need to know not just the direction, but the strength of a trend. For that, we use the average directional index or ADX. This indicator ranges from 0 to 100. If the ADX is below 25, the trend is weak or non-existent. If it is rising above 25, the trend is strong. We use this alongside two other lines called the plus DMI and minus DMI. The buy signal happens when the plus DMI crosses above the minus DMI, provided the ADX is rising. But be careful, if the ADX is falling or weak, you should avoid trading these crossovers because the market lacks the power to sustain the move. We also have a tool for comparison called Relative Strength Comparatives or RSC. This is different from RSI. This tool compares a stock's performance against a benchmark like the Nifty 50 index. We plot this as a ratio line normalized to 100. If the value is greater than 100, your stock is outperforming the market. If it is less than 100, it is underperforming. A powerful strategy is to look for a stock that has been below 100 for a long time and then turns up to cross above 100. This indicates that the stock is waking up and starting to beat the market. Volume is the fuel that drives stock prices, and for this we use on balance volume or OBV. The core concept is that volume usually precedes price. If big money is flowing in, volume rises before the price jumps. We compare the OBV line to its 20-period average. If the OBV line is zigzagging upwards above a rising average, the trend is bullish. A buy signal is generated when the OBV crosses above its rising average. Conversely, if the price is going up but the OBV is flat or falling, that is a divergence warning. It means the price rise is hollow and might reverse soon. Let us summarize the role of technical analysis. It gives you a strategic advantage by allowing you to make decisions based on price patterns and psychology without needing deep fundamental data. It helps you manage uncertainty using tools like moving averages and RSI. However, you must remember the critical context. Technical analysis is not a crystal ball. It is often a self-fulfilling prophecy because so many people watch the same lines. It is a guide, not a guarantee. You must adapt your tools to changing market conditions and always manage your risk. Now, we shift gears to the regulatory side, starting with the Investor Charter. The vision here is to help you invest with knowledge and safety. The mission is to ensure you invest in the right products based on your needs and can access reports to enjoy financial wellness. As a research analyst or RA, the business must be transacted with integrity. This means publishing independent, unbiased research, disclosing any financial interests or conflicts, conducting annual audits, and strictly adhering to the advertisement code to protect clients from misleading claims. Regarding services and disclosures, transparency is key. When a client is onboarded, we must complete the KYC process. We must distribute reports to all clients simultaneously without discrimination. We must also protect client confidentiality. On the right side, you see the mandatory disclosures. An analyst must reveal any material information about their business and disciplinary history. They must disclose the extent to which artificial intelligence is used. They must openly state any conflicts of interest and provide clear caution notices for high-risk products so the client knows exactly what they are getting into. If things go wrong, there is a structured grievance redressal mechanism. Step 1 is to approach the research analyst directly. They are required to resolve the issue immediately and definitely not later than 21 days. If that fails, step 2 is to use the SEBI centralized system called Scores 2.0. This involves a review by the regulator. If you are still unsatisfied, step 3 is the Smart ODR system, which offers online conciliation and arbitration. For physical complaints, you can write to the SEBI Office of Investor Assistance in Mumbai. As an investor, you have specific rights. Under information and privacy, you have the right to confidentiality and to receive all statutory disclosures. Under service and redressal, you have the right to be informed of timelines, to be heard, and to receive satisfactory redressal. You also have the right to exit services as per the terms. Finally, under fairness, you have the right against coercive or unfair clauses and the right to fair and equitable treatment. These rights are designed to empower you in the financial ecosystem. However, with rights come responsibilities. Let us look at the do's and don'ts. On the green side, always deal with SEBI registered research analysts. Always pay fees through banking channels, so there is a record. Read the disclosures carefully before investing and ask questions if you do not understand a complex product. On the red side, Never provide funds directly to the research analyst for investment. Never share your login credentials or passwords. Do not fall for limited period discounts. And most importantly, do not trust anyone offering assured or guaranteed returns, as these are major red flags.